Hello and welcome to Williams Mullen's Benefits Companion, a podcast that helps employers navigate the complex legal challenges of managing their employee benefit plans. I'm your host, Bryden DeWitt, and today I'm joined by the chair of the Employee Benefits and Executive Compensation Practice at Williams Mullen, Mark Purinton. Welcome back to the Benefits Companion, Mark.
Thanks, Bryden. It's great to be back.
Mark is here today to talk about something that can kind of sneak up on plan sponsors when they're dealing with, reductions in force or corporate transactions, which is known as a partial plan termination. Mark, what does the Internal Revenue Code require if a plan has a partial termination?
So if a plan has a partial termination, the minimum vesting standards that are in the Internal Revenue Code, which usually allow you to vest people over multiple years or at the end of a cliff, say 3 years or 5 years, it requires an acceleration of vesting. And it says that the code provides that in the event of a partial termination, all the rights of the affected employees to benefits accrued in the plan to the date of the partial termination, if they're funded, have to be non-forfeitable, or if it's in their credited to their account. So basically, you've got defined benefit plans where somebody's accrued a benefit. So long as the benefit is funded, the funding is there, they must be vested in that accrued benefit. If you have a defined contribution plan, anything that's allocated to their account must be vested if there's a partial termination. So that's in the minimum vesting standards. And it's important because when you have employers who've had a reduction in the number of people who are participating in the plan because of corporate changes, economic downturns, sale of a division, et cetera, those individuals likely aren't able to continue to accrue vesting service. And so they won't be able to grow into their vested benefit. So Congress acted to make sure that they would have an opportunity to at least vest in the benefits that they had accrued before the partial termination.
So it sounds like, a partial termination isn't like a complete plan termination or a total plan termination where the plan sponsor would decide, okay, we're going to, terminate our 401k plan. A partial termination is something that kind of just happens. So what is a partial plan termination, and how would a plan sponsor know if they are headed towards one or that they have experienced one?
So that's actually a hard question to answer. And that, it's been a question that's been bounced around a lot. Back in the 70s, the statute was amended to add this vesting requirement in ERISA, but there wasn't any real guidance. The only thing that we had from the IRS was that it was facts and circumstances determination of whether a partial termination occurred. And so as a result of that, there was a lot of litigation. Many large pension plans got sued when, a plan had a reduction in force, or there was an economic downturn and the factory was shut down, or any number of situations where the number of employees who were in fact covered by a plan, usually a pension plan, ceased to be employed, and they wanted to make sure that their benefits would be vested. And so we had multiple different court decisions and multiple different outcomes based on the circuit in which the decision occurred. And so it became confusing. Finally, in 2007, the IRS published a revenue ruling taking some guidance from those court decisions and coming up with more information about what is a partial termination. And actually, what I think is really helpful, they created a presumption. If the plan has had a decrease in participants during the applicable period of at least 20%, it is presumed that a partial termination has occurred. So there's a lot of little definitions in there that get teased out. A turnover rate of 20%, and whether or not this occurred during the applicable period. What is the applicable period? So let's start with the definition of what is the turnover rate. The turnover rate is math. And there's no way around it. You have to know the numbers, but you start by dividing the number of participants who had, quote, an employer-initiated severance from employment during the applicable period by the sum of participants in the plan at the beginning of the applicable period and any new employees who were added to the plan during that period. So the turnover rate is a fraction. It's the number of participants who had employer-initiated severance from employment divided by the number of employees at the beginning of the applicable period and anyone who was added to the plan during the applicable period. Then that begs the question, what is an employer-initiated severance from employment, which generally includes all severance from employment. And this is sort of overly broad, it seems, when you first look at it. They're saying any severance from employment other than death, clearly that's not employer-initiated,
Right.
disability, retirement, or a termination after normal retirement age. So we're going to assume if you terminated after normal retirement age, you're not an employer-initiated severance. But, that leaves a lot of people who might have left for other reasons, take a job in another company, whatever. But some of that is based on court rulings, which looked at, well, you're about to shut down this plant. The fact that someone left 2 weeks before the plant shut down because they found another job doesn't mean they're not an affected participant. They just were trying to find employment and therefore should be included as an employer-initiated severance from employment.
So that's because employer actions led to the employee quitting and finding a new job.
That's the presumption.
Right. So it's not as simple as, well, these employees tendered their resignations. You have to look at the broader facts and circumstances, the context of the employee's termination.
It's correct, but the guidance does give some comfort to employers. They suggest that employees who fall into that definition, the employer may be able to verify that the employee's severance was not employer initiated. And that can be based on conversations they've had, things in the record, some information provided by other employees who, know, well, this person's spouse took a job in another state and they have left. So that's not employer initiated. But otherwise, the broad presumption is that the separation from service during this period is deemed an employer initiated severance.
And those severances can happen during the applicable period. So it's not a group of employees who were terminated right before the plant closed, but it's a broader period of time that you have to look at to determine the turnover rate.
Right. And so the applicable period, again, depends on the facts and circumstances, but generally it's the plan year, or if it's a short plan year, the current plan year plus the prior plan year, immediately preceding the plan year in which there's a clear presumption. And it can be a longer period if there's a series of layoffs or severances from employment. So we have a RIF and, 15 people go out, and the next month, another 25 people go out. And then the following month, 250 people go out, but that's in a separate plan year. So when you look at what is the applicable period, generally you would look at starting with the first 15 who left and then through to the next whole plan year to determine, what is the applicable period you use for calculating the turnover rate.
So an employer determines the applicable period. It determines to the extent that it can which employees were involuntarily severed by the employer or had an employer initiated severance. And they do the math and they're under the 20% threshold. Is the employer in the clear? Is there nothing to worry about? If the employer comes in at 15% or 18% or 10%, do they have nothing to worry about if they're under the 20% turnover rate threshold?
It's not that the IRS is guaranteeing that they won't be sued, but they have a defense should they be sued, that they did an analysis, looked at the relevant guidance, and came to a conclusion that they were not in the range that is presumed to have had a partial termination. But, if it was 17.5% and directly related to we closed down this plant and everyone was released from employment, and that resulted in a substantial reduction, they may have run the risk of having the employees sue them, the former employees sue them for the benefit. And then you end up in court. Sometimes, especially when it's something really clear, like we shut down the plant, then it makes sense, if there's funding to cover the vesting, to vest the participants.
I see you have a really good argument, but you're not necessarily, I think there's a little bit more analysis that has to happen and a
Right.
risk analysis performed, even if you come in at 19%, or especially if you're close to the 20% threshold. And on the other side of the coin, if you're at 20% or a little bit above 20%, does the employer necessarily have to take the position that a partial plan termination occurred?
They don't. So the IRS was careful to call this a presumption and not a safe harbor. So a safe harbor would be if you hit 20%, then you've had a partial termination. If you have, or you're deemed to have had that. And if it's below that, you don't have to worry, because, that's the safe harbor number. But here, that's not what's considered in the IRS's guidance. They still say it's based on the facts and circumstances. But if the turnover rate is at least 20%, we're going to presume that a partial termination has occurred. So certainly if the IRS came in and audited the plan, they're going to want to look at the turnover rate and they're going to analyze it based on this, and you would have to rebut the presumption.
Right. If an employer is above the 20%, it's a partial plan termination. Who are the affected participants who must become vested?
The affected participants are those who have a benefit in the plan and have separated from service during that applicable period. All the people who had a separation from service, whether they were voluntarily leaving or they employer initiated, all the participants who were in the plan during that period are affected participants.
Right. So it's a different group than when you're determining the turnover rate.
That's correct. So it's a broader group generally. And so you look back to the beginning of the period and you determine who all has severed employment during this period. And then those individuals should be vested. One of the problems is often, especially with a 401k plan, somebody leaves in January, downturns throughout the year, economic downturns causing multiple rifts or whatever. It's later determined there's a partial termination. That person who left in January may have taken their benefit out. So you have to go track them down and give them the portion that was forfeited. That's not at all uncommon.
Well, Mark, thank you so much for this description of partial plan terminations and the consequences. It seems that although we have IRS guidance, there's still, a lot that's kind of unknown. There aren't really bright lines that necessarily tell us whether there's been a partial plan termination. And for me, some of the scariest words as a lawyer are facts and circumstances, where an analysis has to happen and you have to make a judgment call whether the facts and circumstances say that there's a partial plan termination or not. Is there anything else that employers, plan sponsors should know or think about with respect to partial plan terminations?
Well, I think it's, this comes in cycles often. Whenever there's an economic downturn, now it looks like we're maybe not going to go into a recession, but in periods when there are economic downturns and maybe there are repeated small reductions in force, I think it's always helpful to pay attention, to begin starting to think about that. And then if you actually are in the process of having a systematic reduction in force or having to shut down, the sooner you look at this issue, the easier it is to address, because vesting people as they walk out the door before they take distributions is easier than catching up with them a year and a half later when you realize, oops, last year we had a partial termination and we're going to have to vest these people, and many of them maybe have already taken a benefit.
Thank you, Mark, for joining us today on the Benefits Companion.
Thank you. It's been my pleasure.
If listeners have any questions or suggestions for future episodes, please contact me. You can also visit our employee benefits page at williamsmullen.com/employee benefits. There you can find out more about our team, as well as past episodes of this podcast and legal alerts. And finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening.